In this video, I'm breaking down a practical framework for determining your best capital gains to dividend transition point. I'll give you the step-by-step guide for both Canadian and American investors, plus the key considerations to determine when and how to make that crucial shift. Let's start with step 1, determining your turning point. This is the point in your financial journey when it makes sense to begin shifting from growth-focused investments to dividend-producing assets. Contrary to popular belief, this isn't simply a when you retire kind of plan. It's much more personalized. Your turning point is determined by several key factors: your time horizon to needing the money, your current and projected tax brackets, your unique income requirements, your portfolio size and sustainability, and government benefit considerations like OAS, CPP, or Social Security. For example, someone with adequate pension income might delay their transition point, while someone who needs portfolio income sooner might accelerate it. Generally speaking, your transition should begin 5 to 10 years before you actually need the income. This allows for a gradual shift that minimizes tax impacts while methodically building your income stream. Starting too early sacrifices growth potential. Starting too late forces a rush transition that can trigger significant taxable events. For example, if you plan to retire at 65, you'll need portfolio income immediately. Your turning point might be around age 55 to 60. If you have other income sources and won't need portfolio income until 75, your turning point might be closer to age 65 to 70. This is a highly personalized plan. And very quickly, one thing I have noticed is that 80% of viewers who watch these videos aren't subscribed. A great way to support this channel for free is to hit the subscribe button, and I personally promise to continue delivering quality educational content every week. Now, step 2 is the transition approach. This is where we look at how quickly to shift from growth to dividends. While there's no universal mathematical formula that works for everyone, there is a structured approach to determine your optimum transition speed. The transition approach weighs several factors: your time horizon, your tax situation, the growth difference between dividend stocks and growth stocks, your withdrawal needs, and your marginal tax rate. When your time horizon shortens, your tax bracket changes, or the growth difference narrows, the balance shifts towards favoring dividends. Here's a simplified version of how it works. If you're more than 10 years from needing the money, growth stocks typically make more sense because you can defer capital gains potentially for decades. Between 5 to 10 years, a mixed approach often works best. Under 5 years, dividend strategies usually become more tax efficient because you'll need the income soon anyways. Let me share a concrete example. A Canadian investor in a 40% tax bracket with a 7-year time horizon might calculate their optimum annual transition rate at about 10 to 15% per year. This means shifting approximately 10 to 15% of their growth portfolio to dividend-focused investments annually over the 7-year period. For an American investor in the 24% federal tax bracket with qualified dividends taxed at 15%, the same time horizon might yield a similar 10 to 15% annual transition rate. However, if that American investor were in a higher tax bracket where the difference between ordinary income and qualified dividend rates is greater, they might consider a slightly faster transition rate of 15 to 20% annually. The key insight is that this isn't a all-at-once switch. It's carefully calibrated transition over multiple years. The goal is to minimize the tax impact of the transition while maximizing the after-tax value of your portfolio at the point you need to start drawing income. Step 3 is implementation strategy. Once you determine your turning point and transitional approach, you need a systematic way to actually make the shift. There are 3 primary methods for implementation: new contributions, natural rebalancing, and strategic selling. New contributions is the most tax efficient approach. Rather than selling existing growth investments, you simply direct all new money into dividend focused investments. This works well if you're still in the accumulation phase with significant new contributions relative to your portfolio size. Natural rebalancing involves capturing profits from growth investments when they outperform and redeploying those funds into dividend investments. This opportunistic approach lets market volatility work for you rather than against you. And strategic selling involves deliberately selling portions of your growth investments to fund your dividend portfolio. This approach is typically used when you need to accelerate the transition and are willing to incur some tax consequences to do so. The most tax-efficient implementation typically combines all three methods with an emphasis on new contributions and natural rebalancing early in the transition, shifting gradually towards strategic selling as you approach your income need date. And if you want to see how much your portfolio can grow to, you can use the free investment profit calculator in the description and first pinned comment. Now, step 4 is tax optimization during the transition. This is where many investors make costly mistakes. The tax implications of the transition differ significantly between Canada and the US, and understanding these differences is crucial. For Canadians, eligible dividends receive preferential tax treatment through the dividend tax credit, making them potentially more tax efficient than interest income or foreign dividends. Canadian dividend paying stocks should generally be held in non-registered accounts, while US dividend stocks are often better in RRSPs to avoid foreign withholding taxes. And it's important to note that as of June 25th, 2024, the capital gains inclusion rate in Canada increases from 50% to 2/3 for individuals with annual capital gains above $250,000 and for corporations and trusts on all gains. This change may influence your transition timing strategy. For Americans, qualified dividends are taxed at the same rate as long-term capital gains, making them much more tax efficient than ordinary dividend or interest income. The specific rates depend on your income level. Holding quality dividend stocks that pay qualified dividends in taxable accounts can be highly tax efficient, especially for retirees in lower tax brackets. A critical tax optimization strategy during this transition is tax loss harvesting, selling investments at a loss to offset capital gains triggered during your transition. This can significantly reduce the tax impact of your strategic selling. Another powerful strategy is timing your transition to align with expected changes in your tax situation. For example, if you anticipate being in a lower tax bracket in the near future, you might accelerate certain aspects of your transition to coincide with that lower tax bracket period. And step 5 is ongoing adjustments to your transition plan. This isn't a set it and forget it process. It requires regular monitoring and adjustment based on changes in 3 key areas: market conditions, tax laws, and your personal situation. Market conditions can significantly impact your transitional timing. For example, during periods of rising interest rate, dividend stocks often experience temporary price drops. This can create attractive entry points for building your dividend portfolio, potentially speeding up your transition timeline. Changes in tax laws can also necessitate adjustments to your strategy. For instance, if capital gains tax rates increase, you might want to accelerate your transition. If dividend tax treatment becomes less favorable, you might want to slow it down. And finally, changes in your personal situation, such as health issues, inheritance, or career changes, might require recalculating your turning point and transitional rate. The framework is flexible and should adapt to your evolving circumstances. Now, let's talk about a key insight that most investors miss when transitioning from capital gains to dividends: the sector rotation strategy. Different economic environments favor different sectors, and this can be leveraged during your transition. For example, during economic expansions, growth sectors like technology often outperform. During economic slowdowns, defensive dividend sectors like utilities and consumer staples typically hold up better. By aligning your transition with these economic cycles, you can potentially enhance returns while building your dividend portfolio. And the most common question I get about this transition is, should I use dividend ETFs or individual dividend stocks? For Canadians, individual Canadian dividend paying stocks can sometimes offer better tax efficiency in non-registered accounts due to the dividend tax credit. For Americans, both high quality dividend ETFs and individual stocks can work well, with the ETFs offering diversification and individual stocks offering more control over dividend growth and tax loss harvesting opportunities. And another frequent question is, how do I know if a company's dividends are sustainable? This is crucial because dividend cuts can devastate an income strategy. I look for companies with a modest payout ratio, consistent dividend growth history over 5 years, strong free cash flow coverage, and manageable debt levels. These fundamentals matter far more than simply chasing the highest current yield. And one more advanced strategy worth mentioning is the dividend growth approach. Rather than focusing solely on current yield, many successful income investors build portfolios of companies with modest current yields but rapid dividend growth rates. This approach can offer both rising income and capital appreciation, which can be valuable for retirees seeking inflation protection. Over time, this can create a much higher yield on cost while maintaining some growth component in your portfolio. Before we wrap it up, I want to highlight one bonus strategy that can enhance your transition: the barbell approach. This involves maintaining core positions in both high growth and high income investments, with the middle portion of your portfolio gradually shifting based on your transition approach. This approach provides continued growth potential and increasing income, often with better risk-adjusted returns than a linear transition. So to recap the framework, first, determine your personal turning point based on your time horizon and income needs. Second, develop your optimal transition approach, accounting for time, taxes, and growth differences. Third, implement systematically through new contributions, natural rebalancing, and strategic selling. Fourth, optimize the tax efficiency of your transition. And fifth, make ongoing adjustments as conditions change. All right, watch these 2 videos for more investing tips.